All right, let's start out. Again, welcome to all of you. It's a pleasure to be here with you tonight. We will have around an hour, 45 minutes to an hour, talking a bit about different strategies that are profitable that we have tested back in time, and I'll give you a lot of details about that. We are testing this setup here, a bit of new technical software setup where when we get past the first 75% of the webinar, we have given you a lot of strategies, told you how to trade them and so on. And then we will shut the webinar off on Facebook for all those are free users of the My Stock Scanner platform. And then we will continue on the closed YouTube section for those of you that are paid users. So welcome to all of you. We held this webinar yesterday in Danish, and I believe people got a lot of content they could use directly out of the market. So I think you will as well tonight. Welcome to all of you. My name is Hans Henrik. I am a daily manager and owner in Market Time and DK. I'm also a part owner with my good friend Liam in London of this My Stock Scanner platform. And what we are going to show you tonight is screens and ways to use the My Stock Scanner, both as a free user and as a paying subscriber. So what we're going to do tonight is that I'm going to show you some rules-based strategies. And when I say rules-based, I mean completely rules-based. There is no room for making your own decisions. Of course, you can always do that. That is completely all right. But I'm just saying that the backtest we have made, there is no subjectivity in there at all. So when I describe the rules, these are the rules we have backtested and that we can see works. They are based on different aspects of My Stock Scanner, and the first two versions, it's two versions of this same strategy. Basically, I'm going to give you are trend following strategy, momentum strategies where you're buying things that are already running. Trend following is a thing that have been working for a couple of 100 years in the market. That is proved, and we are basically just leaning on an old tradition. The next strategy is a better performing actually, but is a bit more of our own indicators and stuff in the platform. So let's have a look at it. First of all, as a private investor, one of the things that really cost people a lot of money is when their emotions are getting involved in investing. Meaning that you sit there, you own a stock that you believed in because you read something on the internet or in the newspaper or whatever, and then you buy it and it starts to go down. And when it has gone down 20, 30%, you start to doubt yourself and your decision-making process. And you might sell it when it's down 40%, and then, it turns straight up and goes the right direction, and you would have made a profit, but now you are out of the stock, and it's all emotions, it's greed, it's fear, all that sort of stuff. And when we are talking about rules-based strategies, that is to make private investors get a bit more of an edge, and get an edge that we can backtest, so that we can make sure that had we done this exact thing over the last 20, 30, 40 years, then it would have made profit. The strategies I'm showing you here tonight are tested back from the 80s. So basically 40 years in all sorts of markets, bull markets, bear markets, sideways markets, quick crashes, slow crashes, rising interest rates, lowering interest rates, all that sort. So it's not just strategies that are tested when market only goes up, because every fool can make a strategy that profits when markets are going up. But we want strategies that you can use no matter what market we're in. Just remember that no strategy works perfectly in all markets. So there will be maybe a year or a year and a half where one of the strategies are lagging a bit. And that's why in My Stock Scanner, we are building here in the new year a portfolio mixer, so that we come up with a lot of strategies on the website, maybe 10, 15, 20 different strategies that we can see working. And then there will be a mixer where you can choose maybe one or three or five, 7 of the strategies, how much of your money you will allocate to each of them. And then you can see how it would have been if you have traded this mix of strategies over the last maybe 20, 25 years. So that is a new feature that is coming on the platform. All right. So let's jump straight into it and have a look at the first strategy. Now, the first strategy is not really one we have come up with. We have, though, come up with the version 2 of it, but you'll get the first version here. And that is a version that we have found in a paper called Does Trend Following Work on Stocks? Let me just share my screen. That would make sense here. All right. Let's just see here if you can. Good. I know it's a bit small, but I will zoom in a bit here. All right. Does trend following work in stocks? As you can see here, the original paper is from 2005. There is a second edition of the paper from 2008, and they have tested this strategy back from 1984, I believe it is, and then they stopped in the I can't even recall the year they stopped. We can see that in the paper here, but we have taken it on and tested it from there, so we can see that it actually works for the last, or have been working for the last 40 years. And there's not really any reason to believe it should stop working. So what I'm going to show you now is I'm going to show you the exact rules for this, but first I'll show you the performance. And I should say we have changed a couple of small details, but I'll get back into that in a second. But just to show you what this strategy has performed. Now, this test is only back from 2000 and onwards. That is mainly because that our data set has the highest quality after 2000. And in this area, we have had the dot-com crash here over 2000 to 2003. We have had the financial crisis from 2007 to 9. And then, of course, we have had some rough years here in 11, 12, and 15, and 18. And then, of course, the Corona crash. And we have had some tough times over the last couple of years as well. So this is a very good data set. We have had both very strong bull and very strong bear markets and everything in between. So what you can see here is that if you had followed this exact strategy to the letter for the last 23 years here, you would have made 9.13% per year. Now, is that satisfying? Let me see out there. You can type a 1 in the message in the chat if you think 9% is satisfying for you, or you can type 2 if it is absolutely not satisfying. Let me hear from you what you think out there. I'll keep talking meanwhile. What you can see here is that over these years, the S&P 500 has actually made 6.57%, which means that this strategy is doing something like 40% better. And all right, there's someone thinking that 9% is absolutely not enough, and that is absolutely fair. But the 6.57% is what the market has made in these years. And as you can see, both the market and the strategy is extremely volatile here in the beginning, with some big runs up and some massive drawdowns. You can also see that the difference between 9 and 6.5% over 23 years is actually that you get 684% here and 770% here. Klaus, you think 9% is enough? That is great. All right. So what we can see, and one of the reasons why we have tried to improve this strategy is that this strategy has a drawdown of 77%. And Klaus, yeah, you write it completely correctly here, with a bit less drawdown, because 77% is more than most of us can stomach. I did see that Warren Buffett was out saying at one time that if you couldn't handle 50% drawdown 2 or 3 times in your lifetime as investor, then the stock market was probably the wrong place for you to be. And that might be, but 77%, that is a bit much. We can see the S&P 500 during the financial crisis, there a 55% drawdown here. But let's have a look at the at the rules, or actually we can look at the annuals here first. We can see that the strategy starts out very poorly here, losing 3 years in a row during the dot-com crash. Then it had a stellar 2003 with 160% here. And then it is a bit on and off. It has made roughly 20% this year, made minus 14 last year, and it has actually had some very decent year here in 19, 20, and 21. So let's have a look at the rules. When we're looking in this, there are basically just two rules you should remember here. It is extremely easy to remember. The first one is, and I should say this is where we have changed this a little bit, because what this strategy looks at is that when a stock hits an all-time high, meaning that when the stock gets to a point where it has never been before, then you should buy it. That's it. If we look at this one, there are some examples in here. You can see there's the EMC Corp here. You could have bought this here. That was the all-time high. It says here initial entry. Sorry. If you hadn't had an entry here, you could have one here, or all the green dots is where this stock made an all-time high, and you could just have entered any place here. Now we have changed the rules a bit because we are going for what is called 52 weeks high, meaning that it doesn't have to be at the highest point ever. It just has to be at the highest point in the last year, the last 52 weeks. So that is the only change. And the reason is that it gives us a bit more trades, and the trades are divided a bit more out. Sorry about that. So it doesn't make much difference. Just a second, guys. All right, I think that was better. It doesn't make much difference in the performance. It's just that we get more trades every year, and we get them quicker after a bear market. So when the stocks are reaching a 52-week high, then we buy. That's all. And I know it can be a bit hard to do psychologically. Let's take let's have a look at a Danish stock here. Could be let's take the one here, Torm. I think that is a decent example. It's a marine shipping company, and we can see here that one hit an all-time high here. We could have bought it here, could have taken a drawdown. We could have bought it again here, and now we would be in a drawdown again. But the thing that makes it hard is that psychologically we are telling ourselves, well, can it really get any higher? If we're looking back here, we could also have entered here, I think it is, and we could have thought to ourselves, well, it already went up something like 77%. Can it really go any further? And then we would have missed this entire run up. I will get into the exit rules just in a second, but it's just to say this is what we do in this strategy. We buy at a 52-week high, and that's it. All right. Then when do we exit? Well, that is also a very simple rule. They use an indicator. I have put it on the chart here in TradingView. And if you want to put it on yourself, you go into indicator and you search for chandelier exit. Chandelier exit uses the indicator ATR, average true range, which is a way of showing how volatile a stock moves. If it's very volatile, the ATR is very high, and therefore you want the stop loss to be further away. Now, what input are we putting in here? Well, we are looking at the ATR for the last 40 days. So it's looking 40 days back and saying, okay, what has the average movement from day to day been over the last 40 days? And then it is multiplying that by 10. And that's it. Meaning that if we had bought this stock, for instance, here, let's say this was an all-time high, I actually think it is, then it looks 40 days back, multiply the ATR by 10, and that gives us a stop loss level down here. Then time goes, the stock drops and drops and drops. At this point, when the 40 days look back period is removing some data here at the back end, then at some point it actually drags the ATR stop loss up a tiny bit. And as you can see, we would have been very close at being stopped out here, but it went up again. And when it has gone up enough, it starts to move up the stop loss enough. As you can see, it can never go down the stop loss here. It just keeps going up until the line is broken. And then if we look at some point down here, oh, that is far back. As you can see, at some point, the stop loss starts to be on top. But that's not really something we need to care about, because then we won't be at a 52-week high. So right now, had we gone in somewhere up here, we would have been very close at being stopped out. Then we had gone into profit, and right now we would be in a drawdown, but the stop loss had been moved up, so we wouldn't risk our entire position here. All right, that's basically it. Now, in this strategy, we're working with 20 positions, meaning that you find a stock that is at a 52-week high and you buy it. Then maybe 2 days later, you find a new one that is on a 52-week high and you buy it, and so on and so forth until you have a portfolio of 20 stocks. I don't recommend running out and buying 20 stocks at once here because you might experience a drop in the market of 15% the next day, and then basically all your stocks drop. I would recommend that you inch into this and just buy 1 or 2 per day. Now, how do you find these stocks? Well, in here, in the My Stock Scanner, we have some screeners. And the one I have made here is just called 52-week high. Now, the only thing it sorts by is, you can see here the rules. The only rule I have put in here is that it needs to be an index member of either NASDAQ or S&P 500. So if you want to put that rule in for yourself, you make a screener, you add a rule, you press here and say index member, and then you choose that one. And when this one pops up, you can say, okay, which index or indices do I want it to be a part of? So that's it. Let me remove that one again here. Then you look for United States. That gives itself, because NASDAQ and S&P, of course. And the thing you need to look at, we actually don't need to change the momentum. We are here and we're looking at this one called 52-week high. Now, what this one shows us is how close to its 52-week high the stock is. And for instance, we have NVR here, and this is as of the close yesterday. We can have a quick look at NVR here. And as you can see, it was at a 52-week high. Here, there's no doubt about that. And I think it's actually inching a bit higher even today. All right, so this one could have been bought yesterday I could have screened for it yesterday, and then when the market opened this morning, I would just have bought this one. Now, I should say there's a little bug in the system because this one should just be to press here, and then it would sort so that every stock with a 100 up here would be on top, and all the lowest would be down. There's also a tiny little bug about this, so there are few numbers that can actually go above 100, which of course is wrong. So don't use this yet. We are recommending that you wait with all the strategies until the 1st of January, because all of this one strategy you can go into anytime, but the next two, you go into on the first day of the month. So that would be the 1st of January anyway. And at that point, the bug will be fixed. But this is how it works. You buy the stock, find the stocks that are at 100 here, meaning that they are in their absolute top the last 52 weeks, and then you buy it. And then you put your stop loss on, and you check on it maybe a couple of times a week or once per day or whatever you want to check on here. And if you can see it starts to get closer, well, then you might put an automated stop loss in, or you might check up on it every day. but that is basically it. If it drops down here, you get an exit, and then you have a free spot in your 20 slot strategy pool of stocks here. So you just go in here, screen for 52-week high, pick a new stock, and that's it. You can be a bit more advanced and saying, okay, in my 19 stocks I have so far, I have maybe 8 energy stocks or whatever. So if there is one at 100 here and one at 100 here, and one is an energy stock and the other is, for instance, consumer cyclicals, then you might choose a consumer cyclical to broaden out the diversification on sectors a bit. But that is basically it. Have I explained these rules clear enough, or are there any questions for that? If not, I will jump on to the next, to the version 2 of the 52-week high. Would that be okay, or are there any questions for the strategy here? A strategy that is so simple and yet actually makes 9.1% per year, which is significantly more than the S&P 500. So are you okay with me skipping on to the next strategy? Just type yes in the chat. All right, let me see you out there. If you've fallen asleep in all this speaking of numbers and stats. All right, cool. Thank you. Great. Well, then let's go on to the next strategy. This strategy has a lot better stats. If we just compare them, the first one had 9.1% per year over 23 years, which is amazing in itself. The next one is up at 13.9%. It is, though, a bit more active, so you will get a bit more trading costs here, but not a massive amount. But there might be 1% or 1.5% deducted from this number in trading costs. But we can afford that because this one gives us almost 14% per year. Now, looking at what difference that makes, at the 6.5% here, we would have made 384% over 23 years. At 9%, we were making 770% or the same amount of years. This strategy would have made 2,400%. And then a bit of deduction for trading costs, but still we have almost 7-8 times the end results compared to the S&P 500. Also, looking at the Sharpe and the Sortino. The Sharpe ratio is where you are comparing your CAGR, the compound annual growth rate, to your volatility. We want that as high as possible. And as you can see here, this is almost double the one from the S&P 500. Now, what it actually shows is how much you are gaining compared to how much risk you're taking. Now, the Sortino ratio is a bit of the same. However, it is only looking at the CAGR and then compared to the volatility that is going downwards, because we don't really mind volatility going upwards, because that's where we're making money as long as we are long in the market. So I am personally using the Sortino ratio more because it tells me more of how much downward risk I have taken compared to how much money I'm actually making. So a Sortino ratio around 1 is actually very, very good. All right, so what else can we compare here? We had a 77% max drawdown, and comparing to this new 52-week high strategy, that is almost cut in half. And now we are significantly lower than the one here from the S&P 500. We can compare, I didn't show that in the first year, we have a drawdown chart down here. And as you can see, it has taken some really, really steep drawdowns. Even the one here in 16, 17, the one that you can see here, the one in under the Corona crisis, it actually just looks like a little blip. And those of you that invested through the Corona crisis know that was not the case. But that is how it looks here. So we are losing some massive amounts here. However, looking at the one here, you can see that it is not at all the case here in these first years. We do have the financial crisis that gave us the 41% drawdown here, but it is not at all as severe. And this one looks a lot higher, but it's just because it is compared to lower max drawdowns here. When we're looking at, we can also compare the annuals here. How is this strategy actually faring? And as you can see, we are actually in 2000, 2001, 2003 here, where the first strategy were giving us some quite severe negatives. This one is in positive, and even in some very good positives here. Then we have 160% year here in 2003. That is, of course, well and good, but I would like a 63 instead, and then not having had 3 years here with a ton of drawdowns. And as you can see, over these 23, 24 years, there is one losing year ending up in a loss year at 17% in 2008. Then there was the tough year 2011 at -7%. And the 2018, if you remember, that was where the year was actually going fairly okay. And then the effect of rising interest rates started to kick in. And we had a Q4 in 2018 with around 20% down. And that was what killed many strategies. So here we can see that -7% was actually decent. It was not as good as the market. So this strategy is not beating the market every single year. You can see 2018, this was 2011, and then 2018 here, where the market ended in the negative. A tough year last year, where the market ended in -18%. The strategy here made 6.5%. Now, this year, we haven't beaten the market so far. I don't think that'll catch up the last couple of weeks here. So 9.6% is fair for the year. But we should also remember, and you should basically always think of that when you are seeing someone comparing performance to S&P 500, because as you might know, the S&P 500 this year has actually not made 20%. Well, of course it has, but that is because that 55% of the weight in the S&P 500 comes from 7 to 10 stocks. There is the Amazon, Google, Meta, Facebook, and these stocks, and because they have skyrocketed, the S&P 500 is up a massive 20% this year. But if they hadn't been there, if that would have been an equal weighted index, we can actually have a quick look at an equal weighted index here. We have the equal weighted S&P 500. And if you compare that to the normal S&P 500, here you can see some quite large differences. The equal weighted, meaning that every single of the 500 stocks have the same weight in it, started the year here and is now up at 8-9%-ish, not at all the 20% that the normal S&P 500 is doing. So that is quite a significant thing, and you should remember that when you see people comparing their performance to S&P 500, because this year you would have needed to be in those 7 stocks to beat the market, or at least do as well as the market. All right. Now the rules for this strategy that is so much better. Well, it is actually very simple. We go into the screener here, and we have the 52-week high version 2. Now, what are we looking at here? Again, we have said that the index member should again be NASDAQ 100 and S&P 500. And Klaus, you say strategy seems to be better than S&P in bad times, but worse in good times. And yes, that's actually often the case with many trend-following strategies of this sort, because that normally when market turns, at least if they drop steeply, turns around and go very quickly up, then trend-following strategies need to detect the trend first. And that takes a while, depending on what strategy it is, meaning that the first part of the uptrend, of the quick uptrend, we are actually out. However, in the steep downtrend, we are also being sold out via stop loss or whatever we are using, meaning that we are not getting the same kick from the downtrend as well. And I do prefer that myself, definitely. All right, what have we screened for? Index member, NASDAQ 100, S&P 500. There was some question at the Danish webinar yesterday saying, is this working in Danish, Swedish, Norwegian, French, UK, German stocks or whatever? And we are very certain that it does, but we have not tested it thoroughly yet. The reason for that is the data we have available, because what we are testing on right now, the S&P 500 and NASDAQ, we have the constituents, we have the stocks that have been in these indices every single year back in time. Because let's say in 2000, 1999, 2000, we could have tested on a ton of stocks there where 80% of them might have gone bankrupt because it was tech stocks and they went bankrupt under the dot-com crisis. Now we need to test on these stocks even though they don't exist anymore, because otherwise it might skew the results, and we need to test on the stocks that were available every single year. And that is where a lot of strategies are missing out, actually. It is called survivorship bias, that you are only looking at the stocks that survived. Yes, it is actually, I don't know if you know it, I'm an old history teacher, and it is a concept that they learned under the Second World War, where they examined the planes that got home, had been out fighting the Germans, and then they examined them and saw where they had been shot, if they were severely damaged. And then it appeared to the people on the ground saying, oh, by the way, we are only examining the stuff that gets back. We need to find some of the planes that got shot down and figure out why did they get shot down. We don't have much use of just looking at the planes that survived. And that is why it's called survivorship bias. All right, that was a little history lesson for you out there. Anyway, let's look at the strategy. Again, index member. Then we have the daily TPI, and the TPI is the indicator. If we look, for instance, here at AutoZone, and we look at the TPI chart, then the TPI chart is these three colored rows down here. We have the long-term trend, we have the weekly TPI, and we have the daily TPI. Now, it's important to say that the TPI is very different from other indicators. It's an indicator that I have dreamt of making for many years now, but I'm not a programmer. But fortunately, I have teamed up with a very skilled programmer in UK called Liam. Many of you have written with him if you are somehow connected to my stock scanner platform. And he took my ideas and put it into code, and that is really exciting to see. So what we're looking at here is we're looking back in time and saying, how has AutoZone, for instance, it is different with every single stock. We are looking back at the exact stock and looking at the movements. So we are quantifying the movement we are seeing here, and we are saying, okay, what has happened all the other times it has made a movement similar to this? So these indicators here, the lower one can only be in green or red, meaning down or up. This does not mean that the stock is currently going up. It means that statistically, there is a high probability for it to go up and keep going up. Then we have the two upper rows here, and they have four different colors. They have a dark green, meaning that it is actually the indicator is already pointing into an upwards direction. We have the red saying it should actually already be in a downwards direction. The stock doesn't necessarily have to be so, but that is what the statistics are saying. Then we have the light green and the light red. And what they show is, imagine that this had been going up, up, up. And at some point it starts saying, well, the trend shouldn't be as strong now, because statistically we should be in what is called an accumulation overbought phase. So it is in an area where we should soon see some seller pressure. And again, with the light red, it is saying, okay, we have been at least statistically going down for a while, but now we are entering a zone where it statistically ought to start going up. Now, this is on a weekly chart. This is on a daily chart. The reason that I just go into that is that what we are screening for here in the rules is we are screening for the daily TPI being in oversold, accumulation oversold. In the screener here, there is both down oversold and up oversold, but that is a way we are measuring some statistics here. You should just choose the 2 oversold. That means that it is in an accumulation oversold phase, and statistically there should be coming in some buying pressure. All right. So what are you doing then? We take here, let's just see. Yes, we have the 52-week high here. If you can't find it, there are some different layouts and you should have the one saying momentum. In here, there's a 52-week high. And again, as I said, there's a little box, so you can't sort, so you get the highest first. But what you need to choose is all of these stocks are a member of the 2 indices, and they have their daily here in oversold accumulation phase. Then you should choose the 20 stocks that are closest to the 52-week high. And now you can't see them here because we can't sort for them, but that will be solved very quickly. So when you press this one, when the bug is solved, you will get all the ones with hundreds up here. Hundreds up here, and then 99 and 98 and so on. And you choose the 20 best. And you do that at the first of the month, meaning that you maybe make this screen at the end of the month. Let's say it was for November. Then you would have done it on Thursday, the 30th of November at night, when all the data here has been updated. Then you get a list that is in TPI daily, in oversold accumulation, and you choose the 20 stocks that are closest to their 52-week high. They should, however, be in the top 5%. So somewhere between 95 and 100. It's normally not a problem finding 20 stocks there, but there could be one time there were only 17, and then you only invest in 17 stocks. All right. So if you have $100,000, you divide it by 17 instead of 20. Then you hold these 20 stocks for a month until the next first. Then you sell all the stocks. Well, you don't necessarily have to sell all the stocks, because there might be 1 or 2 or 3 that are just the same stocks as last month. So of course you're just letting them run, and then you sell the rest, make the screen here, and buy the number of stocks you need. Hold them for a month, do the same, hold them for a month, do the screen again, hold them for a month. There's no stop loss, there's nothing. You just hold them for a month and then reallocate your money. That is as simple as it is. And doing that since 2000 would have made some quite stellar returns, I would say. Most money managers would give away several body parts to be able to make 14% over the last 23, 24 years here, I assume. All right. Are there any questions to that strategy? They are fairly simple, but of course there can easily be questions for some of the nuances here. Or are you completely, do you understand the strategy here completely? All right. If I don't get any questions, I assume that you understand the strategy. Yes, Klaus, you ask here that in my stock of the day video, I make use of weekly TPI. What does backtesting show for that? Well, we haven't done any completed backtest of the weekly TPI yet. However, I did make some videos where I showed that we were testing if there is an edge, if there is a statistical edge in using the TPI. And in there, I showed that if, for instance, just buying the weekly TPI oversold accumulation phase, either going down or up, and that's it, and then holding it for 5 days or 10 days or all the way up to 130 days, it showed that there was an edge. So I don't have a complete strategy back tested like this. We are working on that, and we're also working on testing on other markets with some solid data. So the reason in the stock of the day I'm just using that is that it is simple. We can see there is an edge. There is that on the daily as well. I'm looking a bit further ahead with the stock of the day, because I'm also using the the value chart, as you might remember. Therefore, since I'm looking maybe 1 or 2 or 3 years ahead, then I'm using the weekly instead of the daily. But we will come up with some solid stats on that as well. And I'm pretty certain that we will find there is some solid performance for that as well. All right. Now we're getting to the last strategy, and that is the part where I will be shutting off, not now, so just stick around for those of you that are still on the Facebook Live. But I will tell you about the performance. And then for those of you that are members, paying members of the My Stock Scanner, you are watching this right now, I assume, from the special YouTube link you have gotten. And therefore you will just stay on YouTube, and there shouldn't be any interference. At some point after I have shown you the stats for the last strategy here, I will be saying thank you for tonight to those of you that are watching this from Facebook Live, and then we will be shutting the stream up to Facebook. So the entire recording will be available in a day or so in the paid membership area on My Stock Scanner. So if you choose to become a member, then just join, and you'll be able to see the rules for the strategy. All right, let's jump straight into it. We are calling this the TPI Plus strategy. And what it does is it makes 19.9% per month. Okay, Monica, remember to like, share, to spread the value. Okay, thank you very much, Monica, and I'll send your greetings to Liam as well. Liam is doing a killer job doing all the support and all the technical. It is a fairly new platform, so there have been a few bugs in there, but you have been very patient with us, and Liam is really doing a stellar job from his office in London there. So I'll be sure to bring your greetings to him, Monica. All right, the CAGR of this strategy is 19.9%. And this is actually kind of the performance that Warren Buffett is making. And even a bit above, actually. We are up in the range where we are doing 3 times as well as the market. It's not that we never lose money, because as you can see down here, we still have drawdowns. There are drawdowns here in 2000, 2001, and 3, the financial crisis. There's the Corona here, the 2022. So it's not, as I said at the beginning, all strategies have hard times. There are conditions in the market that we cannot either predict or mitigate in any way with every strategy, or all strategies have their weaknesses. What we are trying to do here is to make strategies that are as capable to handle the drawdowns as possible. And if we're looking at this one, the strategy with the 52-week high just from before, 13.9%, that gave us 2,400% over 23-24 years. This, adding a 6% extra gain here on the CAGR, sent us from the 2,400 to 8,800% over the same number of years. That is quite a lot, and it means quite the difference if you're going to retire on this amount. As you can see, the Sharpe ratio, 0.67 and 0.95 in the 52-week high. In this strategy, that jumps up to 0.78 and 1.16. So quite amazing. Max drawdown is a tiny bit higher. As you can see, 41% with this one, 45% with the TPI strategy. However, getting 6% extra per year, I would gladly take an extra 4% in drawdown, definitely. The volatility is also a bit higher, as you can see, 19% in the former strategy here and 25 here. So that is the price you're paying. And you should also always remember, as it said, there are no free lunch in the market. So when you want some enhanced performance, you often pay a price somewhere in the strategy. And here you're paying the price in higher volatility and a bit higher max drawdown. And that is, of course, something you should decide for yourself. In this case, it is a price I gladly pay for getting almost 19% per year. Looking at the performance here, comparing year to year, you can see that the form of the 52-week high has had 9, 6, 24, and 10 here. When we're looking at the TPI strategy, you can see 12 and 12. So it's done a bit better the last couple of years. Then a whopping 38 and 9 here. I haven't had a losing year since 2015 here, where it had minus 2.6. Also had 2012 here. And the worst year in this was actually the 2002 and the dot-com crash with a minus 22%, roughly the same as the market. But the 2 year before and the year after was absolutely amazing. So this is the stats for the strategy. And this is something that, at least in those of you that know me from Market Time Special, my Danish subscription service, where we talk about Scandinavian stocks and write my morning piece and all this, I can say that I'm still using a trend following strategy there. But in my US stocks, I am more and more leaning towards some of these 100% automated strategies. In the Market Time Special, it is a bit where there's 5 or 10% subjectivity. I can choose to go with one or don't go with it, and that can be a bit of market judging in there. But in these, not judging at all, not using my feelings or my subjectivity, just putting trades on and leaving them, and you'll get the rules just in a second here. So that is what I'm doing. We will get in the future here. We have a long list of to-dos here, and of course the programming part is mainly Liam doing that. But as I mentioned in the beginning, we'll make this portfolio mixer, which I'm really looking forward to. They can mix all sorts of different strategies. If you are you want a lot of risk, if you want a lot less risk, if you want to focus on having a low drawdown and all that stuff, and you can mix between 15, 20 strategies that we are adding just on an ongoing basis. So we're looking forward to that. And in that, there will also in time be strategies that are completely focused and tested on, for instance, Scandinavian markets or European markets or wherever you live in the world. That'll also be in the paid section on my stock scanner. We are starting to build a large educational part. That is mostly me doing the education. There'll be a lot of free education. Well, there'll be some free education for everyone logging in, free users of the platform. Then there'll be a huge educational library with everything basically I know put into videos that is in there. And that is also from there, I will make my option education when that gets online at some point. That will be an extra paid service, but that will also be under that umbrella. So we have a ton of new features coming in the new year. And I know many of you out there are writing to Liam suggesting new features, and many of them we haven't thought of, and we're putting them in programming and if it's possible. So thank you for adding to the idea list there. All right, it's time to go into the rules of this strategy, and therefore I will say thank you for those of you watching from Facebook. I will be turning the live feed to Facebook off now for those of you that are free users. Thank you for your time tonight. It was a pleasure having you here. And those of you that are on YouTube, you just continue, just do nothing. I will be with you just in a second. Just shutting the Facebook part off. Let me just make sure we do it right here.